Hey, everybody. Welcome to our Fund One webinar update. We're going to go ahead and get started in just a moment. My name is Ryan Gibson, and I'm the Chief Investment Officer for Spartan Investment Group. And today we're really excited to bring you a update on the fund. This is our July 21st update of 2022. And the things that we're going to talk about tonight are going to be mostly around what assets that we've purchased for the fund and what assets do we have upcoming that the fund is going to purchase. We're also going to give a bit of an overview tonight about the market and where we think the market is headed, kind of what we're doing to mitigate risk, and some of the exciting things that have already happened in the fund with the first property that we've closed upon. So if you haven't joined us before, this is Spartan Investment Group Spartan Storage Fund 1 webinar. Thanks for tuning in, and we're going to go ahead and get our disclaimers out of the way. We're not offering any legal advice. Do your own due diligence and consult your tax and legal team. And again, this is just a general overview. I'd like to introduce the executive team here at Spartan. Our CEO, Scott Lewis. My name is Ryan Gibson. And Ben Lapidus is our Chief Financial Officer. And so what Spartan Storage Fund 1 does is it solves the overall investment of acquiring $400 million in new self-storage into the fund for Spartan Investment Group. And it provides investors the opportunity to really diversify and mitigate their risk across multiple facilities and markets. And we target about 60 to 80 properties. And with that, we plan to raise about $150 million for Spartan Storage Fund 1. The targeted returns are about 15 to 20% cash on cash when you include the sale of the investments and the cash flow along the way. And we're projecting about 5 to 8% per annum cash flow. This is per annum cash flow that we distribute on a monthly basis, and returns or distributions are sent out on the first of each month. And that works out to about a 13 to 18% levered IRR. And about double your money over the 4 to 6 year hold that we project for the fund. So everything that we do really focuses on one thing, and that's mitigating risk. So where are we in the market today? We have inflation. We have a record CPI last month reported at 9.1, but we also have some confusion. We had 372,000 jobs added to the market back in June. And we have the lowest unemployment rate that we've had since the pandemic set in. So kind of where do we kind of think things are going? Well, the first thing that we do at Spartan is we really stick to fundamentals. We have not changed our investment strategy as we go into the recession that is pending. And the reason why is because we never buy deals that don't have risk mitigation built in, meaning that we're always buying deep value add deals that have a high cap rate conversion. We're always finding off-market properties that can stomach a little bit of disruption or drop in occupancy. And we always are really conservative in our underwriting of the financials and the financing that we put on the property. And we do our due diligence. So we run a 700-point due diligence checklist. And ever since we've started buying self-storages at Spartan, that checklist has only gotten larger and larger and larger. We do boots on the ground due diligence. So our construction company goes to the property, our property management company goes to the property, all of our acquisitions team, and even a member of IR go and get their hands around the property. We order property feasibility studies for each location. We do a property inspection, and we run very, very thorough due diligence. So we're really sticking to fundamentals. And the reason why we switched to self-storage back in 2016 is because we thought there was going to be a recession back then. And we wanted to pick the asset class that performed the best during the last downturns, specifically 2008 to 2009. Self-storage is one of the top performing asset classes in a recession just because it's dependent on life events. And life events get more and more intense as the market changes and we have disruptions in the economy. So we've really been bullish on self-storage. It does good during a good economy, but it does great during a bad economy. And that's why we stuck with self-storage from the get-go. Because of our fundamentals and our finding the diamonds in the rough, our acquisitions has slowed because we are underwriting higher interest rates. We're underwriting lower amortization schedules in our underwriting. We're underwriting more disruption in our underwriting, and that's naturally killing off more deals. Same fundamentals, but we are underwriting these facilities to work under tomorrow's terms and yesterday's terms. So we want to make sure that we're buying the right property, and naturally, because of the market that we're in now, we're not buying as much that we intended. We've almost cut our acquisitions in half so far and our projections so far this year. So we are really getting picky on what we're buying, and we're just sticking to our guns. I love the saying, marry the property, date the interest rate. So one thing that our capital markets team is doing is we're finding great properties, and we're either buying them in cash and waiting for a good time to refinance that facility, or we're making a negotiation with our lenders that we have no prepayment penalties on the loan. So if we decide that we want to refinance this property sooner than anticipated, guess what? We can swap that interest rate out. So we think the interest rates are going to lower over the next 2 to 3 years, and we're marrying the properties, we're buying them, but we're only dating the interest rate, meaning that we can swap out the interest rate at a lower time. Now, if that doesn't happen, we still are getting a great rate and a great underlying financing of the facility, but we're keeping in mind that, you know what, this rate we're getting today in the mid to high fives is probably not what it's going to be in the future. So let's make sure we can get out of that loan without huge penalties. Strengthening relationship with lenders. We've continued to grow our capital markets team and really go deep with our relationships with our existing lenders. And that's been really, really important during this time. So why storage? Again, I talked a little bit before about why we think that this is a darling asset class for a recession. When we start to have a recession, we start to benefit from that. So if you look at the last 4 declines in real GDP growth, self-storage occupancy has remained solid for the last 25 plus years. So we really like that. That's what attracted us to this asset class in the first place. During COVID, we saw a downturn across commercial real estate asset class types. However, self-storage was one of the least challenged by the COVID-19 pandemic from the return perspective here. And when talking about self-storage being disrupted versus all other asset classes, take a look at how the gold bars of how badly some asset classes were disrupted. Self-storage saw a 9.4% decline, but an 82% increase during the heart of the pandemic, which is really impressive. And this is kind of the status of how self-storage have done in previous recessions and during the COVID-19 pandemic. What's great is self-storage, well, fortunately for us, is dependent on life events, like I mentioned earlier. So when you lose your job, you downsize, you relocate, you get divorced, you get married, you have kids, whatever it might be, people are going to use self-storage. And that's why disruptions in the economy only benefit this asset class. So what did we purchase for the fund? We're really excited to announce that on June 28th, so just last month, about 27 days ago or so, we closed on Plaza Mini Storage. This was a stabilized property, over 95% occupied, just outside of New Bern, North Carolina. And we fully funded this deal and we paid all cash for it. So now we're opening up the next tranche of the fund. And that's going to purchase a 2-pack just outside of Louisville, Kentucky. And that's a $12.5 million purchase. This is a stabilized Class B property. We're going to go into the details here in a minute. But the important part is that we are opening up the second round of funding for the fund. And anybody who participates in the fund in the second tranche gets a share of the sweat equity of the first deal. So every investor in the fund is going to benefit from all facilities that enter the fund. And that's great because you get to take advantage of what the hard work that's already gone into the fund and any new acquisitions that we have going forward. We've already 90% committed the second tranche, and it's based on first come, first served when your funds are received. And our planned closing timeline for the Louisville, Kentucky properties is in the next 2 to 3 weeks. When we do close on this property, your preferred return will go active upon closing of the facility. Our first distribution for the fund, for those that invested early and got in on that first tranche, is planned for September 1st. There might be a distribution in August. We're just seeing how fast we can get the books closed up and make a distro. It might happen in mid-August, but September 1st, you can plan on that first distro. And again, kind of highlighting the sweat equity that has gone into the fund for those new investors or for those investors who might want to up their existing investment into the fund. We closed on the facility June 28th. I'm so proud of the acquisitions team. They bought this 40% below the market value, meaning that if the market goes down 10, 20%, we still have equity in this project. So we paid about $70 a foot for this property, and some of the properties in the market were trading well above $100 per square foot. So we really got a deal on this first storage facility in the fund. The rents are 51% below market, which is insane that some tenants haven't had their rent increase since the 1990s. So we talk about 9.1 and recent inflation in recent time, but talk about no adjustments to rents since the 1990s. So 30 years, these customers haven't had their rents increased. And the facility, when we took it over, we immediately significantly raised the rents, and we had 21 new customers move in at that significantly higher rate. And we're planning on rent increases to go into effect October 1st, November 1st, and December 1st of this year. We do our rent increases in phases so that we don't completely shock the system with the property. Right now, it's 98% occupied. When we bought it, it was 95. And again, those 21 new tenants moved in, and the market is nearly 100% full. And there's over 800 homes planned to be built around this facility. And there's just really strong demand in the area. There's actually, we calculated 100,000 additional demand within a 10-minute drive time. So this property is really a nice buy to seed the fund for the first deal. It's also the nicest facility in the market. From a terms of a quality perspective, it is just a really nice looking property that, really just like a lot of the other properties are just kind of grass, drive aisles, and, no fence and things like that. We have a really nice Class B vintage property here. And here's some of the pictures you can see. We're going to work on doing an office renovation, repaint the property, kind of just fix up some of the, the downspouts, the gutters, the roofs as needed. We're carrying an extra $1 million of property improvements for this facility. So overall, just a really nice property. Some highlights of it. It's in Havelock, North Carolina, which is considered Craven County, just outside of New Bern. We consider the New Bern MSA part of this property. And it's about 20 minutes from the Outer Banks. So we benefit from the military base that's right down the road, and a lot of folks traveling to the Outer Banks area. Huge property, actually one of the largest single asset facilities we own, about 1,528 units. That's 191,000 square feet net rentable, and about 40,000 of it is climate controlled. So it's got this really nice unit mix of outdoor facing exterior units, which people love, and indoor units, which people really like, especially in North Carolina, because it gets really hot and they're looking for that humidity control inside the unit. Again, 98% occupied. Market occupancy currently sitting at about 99.4%. And again, about 100,000 square feet of demand, excess demand within a 10-minute drive time, which we love to see. So let's talk about the next tranche. This is the next property that we plan to close in the next 2 to 3 weeks. Let's talk about risk mitigation. So we're buying this facility. We're at an uncertain time. How have we mitigated risk? Well, first and foremost, all of our facilities go through our standard rigorous 700-point due diligence checklist. We share this with our investors. This is on our website to download. And we go through all of this risk mitigation process. And because of that, we caught a $250,000 negotiation while we were under due diligence, because the seller said, oh yeah, everything's fine. There's, the roof is fine and all this and that. Well, we still follow our checklist to a T and found that the roofs on one of the buildings needed to be replaced. So we negotiated a $250,000 seller credit prior to closing, which is great. What's also nice is the bank that currently holds the loan loves this property so much, believes in this property so much because it's one of the nicest in the market, that they wanted to keep the loan in place. So because we're great operators and good borrowers, the property is in really good shape and they like lending on it. They committed already. We have a full committee, loan committee approval at a 5.26% interest rate, fixed rate, for the life of the loan. And they've even given us an interest-only period for 9 months to really help with cash flow. And then it converts to a 25-year amortizing loan. So some highlights of the deal. Let's talk about the market. Severely limited competition. That's what we want in self-storage. We want high growth markets and severely limited competition. So this facility, as you can see in the picture, it's pretty much brand new. I believe one of the facilities was built in 2017 and one in 2019. So the facilities are brand new. There's no competition, and it's the nicest facility in that micro market just outside of Louisville, which is what we love. It's a growing market in an affluent area with high household income. So again, perfect. We have high income earners. We have people growing in the market, going to the market. Shelby County is the 10th fastest growing out of the 120 counties in the state of Kentucky. So we're talking about, this is where people are moving. This is where the jobs are going. And we have severely limited competition, which is fantastic. Our rents for these facilities are 10% below the market rents. And it's near the golf club that the PGA Tour is held at. And that just kind of speaks to the quality of the area. Our plan is to convert 4,400 square feet into storage so we can get that higher producing dollars per square foot. And there's two properties that we get in this transaction within 7 miles of each other. So we can share payroll, we can get economies of scale. And as we'll talk about on a future webinar, we're actually planning on buying one more facility in Louisville in another transaction. So we're really going to have scale in this market, which makes this exit strategy have more optionality, et cetera. So let's talk about one of the first of the two properties. This one's in Shelbyville. We really like the scale. And in this property, we really like the conversion that we can do with the warehouse. This one's in Shelby County, and it's about 25 miles outside of Louisville to the east. This one has 495 units. It's about 74,000 square feet, and it's got climate controlled in the facility, which is great. It's currently about 87% full. The market is almost 100% full. Again, this property was built recently. And so it's just finishing its lease up, strong demand and really, really limited competition. Here's some pictures of the facility. As you can see, they've got some RV storage here. That was another thing that I wanted to talk about. We caught that in our due diligence. Our entitlements manager actually found out that the RV parking here wasn't zoned correctly. So the city could come by at any time and kick all the RVs out. So we went back to the seller and said, hey, we can't close on this property until we have the right entitlements on the property to get the use out of these RV storage. So we actually had the seller go back, and just yesterday or 2 days ago, they actually got it fully approved for the zoning. And that's why we're putting this one back on the docket to close for the fund. So we got the zoning issues all taken care of, which is great that our process caught that. And you can see that they have some interior units and some exterior units as well, which is a unit mix that we really like. The other property just 7 miles down the road is Free Up Storage Simpsonville. Again, this one is brand new. About 2019 is when it was constructed. Really nice construction. You can see the concrete drive aisles there, just your standard drive up metal buildings. And it's in Shelby County, which again is the 10th fastest growing county in the state of Kentucky. And it's about, again, 25 miles from Louisville. This one's a bit smaller, 297 units and about 40,000 net rentable square feet. And it's sitting about 76% occupancy with the market full. No competition in the immediate area, which is what we love about this property. So some of the pictures looks like aren't rendering there. But basically, we're going to talk about, how the investment works. So how does your funds in the Spartan Storage Fund one work? Well, first of all, we start with investors coming in on a first come first serve basis. And some of my icons here are missing, but basically the storage fund second tranche that we plan to close on in 2 to 3 weeks, 100% of your funds, no matter what you invest, will go active based on in 2 to 3 weeks into the fund. And then we spread out your investment across all the funds. So the fund will buy everything. You'll participate in the benefit of anything we've purchased previously and any new investments that go into the fund. So talking about next steps, if you want to invest in the fund or even make an additional investment, you can sign up on our website, spartan-investors.com. And you can log into our investor portal. You can see the little red circle there. It's on the top right of the website. You can log into our portal. And if you have any questions about signing up or registering with your trust or an entity or things like that, you can contact us at investors@spartan-investors.com. And for now, we're going to go ahead and open it up for a Q&A. What sort of depreciation are we expecting in the fund? We're expecting about 25 to 30% of the investment amount to be depreciation. Is there room for expansion at Havelock? There might be, but even better than expansion is when you have rents that are so far below the market, you can create tremendous value without even having to put a shovel in the ground. So that's why I think we really like that. Timeline for selling the property and cashing out the fund. Multiple exit strategies. We do have scenarios where we've refinanced out facilities and returned investor capital early. We've sold properties early, many, many years earlier than projected. But however, the fund projects a 4 to 6 year hold period. Do you do cost segregation studies? Absolutely. Every property gets a cost seg study, and we apply 100% bonus depreciation that benefits our investors in the fund. How many properties will be in the fund? 60 to 80. How many properties do you have now? We have 54 store locations across 11 states. We have about 25,000 units, and that's mostly self-storage, about 95% of it self-storage. If I invest $100K, how much of that will be written off in the first year? We project $25,000 to $30,000 to be written off in the first year. And folks, if you have any questions, feel free to drop them in the Q&A. Alternatively, there's a email on the screen. And if you think of something later, you can always email investors@spartan-investors.com, and we can answer any questions that you have about the fund. Any opportunity for 1031 exchange capital coming into the fund? No, we don't accept any 1031 exchanges into our syndications anymore. We did that last year 4 times. And it's very complicated for all parties. Just kind of a short answer there, but it's very complicated. What is the term of the loan? What is the plan for K1s with 55 to 60 assets in the fund, individual or composite, etc.? Great question. I love this question. So the terms of, currently the asset that we own in the fund, the Havelock deal that we closed in June, there is no loan on that. We paid 100% cash. The Kentucky properties we are levering, it's about 68% loan to purchase price, and it's even a lower LTV when you consider the capital improvements. I think it's like drops down to like into the low 60s. You will get a K1. You'll get one K1 for all 55 to 60 properties. And as far as individual or composite return, we do an individual return. We don't do a composite return. And I would highly advise you to talk to your CPA about this. But I invest personally in syndications and obviously into our own funds. But my CPA tells me that if you do a composite, you actually lose the ability to do depreciation rollover. So if you're doing a composite return, I would really look into that and make sure that it's right for you. Again, I'm not a CPA, but I would really kind of talk to your CPA about that strategy. That's why we don't do it. There's also a lot of complications to understanding if you've already filed in that state inside of the admin process that goes behind that. So we don't do a composite return. Does your K1 include state level detail? Do I have to pay taxes in the various states in which the properties are located? Again, I can't give CPA or financial advice. What my accountant has told me for my personal situation, that because of depreciation, I won't be paying taxes or filing in the individual states until I have an actual gain. But it will include the state level detail from my understanding. How many states are in the fund? Currently, there's only 1. But with Kentucky, that will be number 2. And we project to have Florida, North Carolina, South Carolina, and Kentucky in the fund at this point in time. Well, thank you, everybody, for attending the webinar. I see many of you on the webinar that have already invested in the fund, and I just wanted to thank you for your investment. Thank you. And those that haven't, thank you for your consideration. And if you have any questions, again, reach out, and have a great evening, everybody. Thank you.